Hi guys, this is Liz Brown with Accounting 2301, Financial Accounting with Richland College. Wanted to discuss Chapter 2 and give you some information and also work a practice problem together. What you're seeing on your screen now is something you've seen in the presentation slides. It's also something you've seen in your readings. This is a great tool to help you guys with journal entries as we're learning them. I call it DEALOR. It stands for, on the left side here, dividends, expenses, and assets. And on the right side, liabilities, owner's equity. Before we were calling this shareholders' equity, so we're calling it owner's equity here, and revenue. All right, we'll do some examples of these, but the left side is increase with the debit and decrease with the credit. The right side is decrease the debit and increase with the credit. So we'll do a lot of examples to show how this works. This is a great tool. It helps you keep organized. Please consider putting this on your 5x8 single-sided handwritten note card for the exams. I think you'll find this very helpful. A couple of notes also on what you're going to see if you go out into the business world. People abbreviate debit as DR and credit as CR. I realize there's no R in the word debit. This is something from Latin. It used to be called, I believe, debitor with an R in it. But you're going to see DR for debit and CR for credit. Another thing I want you guys to realize is that there's no such thing as debit is good, credit is bad. As you can see, it just matters which account you're in and which side you're in. So let's do an example of a problem here together. So what we have here is we're receiving cash for providing a service. All right, so doing one of these accounts, we ask first, what's one account? Did it increase or decrease? What's the other account, and did it increase or decrease? And then at the end, the important part is, do we balance? All right, so we received cash. So we are a company, we received cash. The account is going to be cash, so that's the account. Did it go up or down? Well, we received the cash, so it went up. Then we determine what type of account is cash. The choices are dividends, expense, asset, liabilities, owner's equity, or revenue. Well, we can use our chart of accounts, and we know that cash is an asset. The asset went up, so it's going to be debited. The debit is going to come over here. It's going to be all the way to the left, and it's going to be cash of $100. Well, what's the other account? We provided a service. So as a company, we provided a service. That is going to be service revenue. Did our service revenue go up or did it go down? In this case, we provided the service, so we are going to increase that account. Which type of an account is it on DEALOR? All right, that one has the word in it, revenue. Service revenue is a revenue. We are going to increase our service revenue with a credit. Now we're going to have service revenue. We're going to have an indent here. That is required to have that indent to show the difference between our debits and our credits. All right, so indent here. Note that cash is increasing with a debit. Service revenue is also increasing, but with a credit to be balanced. So both accounts are increased, one with the debit, one with the credit. No such thing as debits are good, credits are bad. So I want to make sure that that's an important point that some students struggle with. All right, we also need to add a date up here and a description in this journal entry. All right, guys, let's move on to some examples from the book. I'm going to go ahead and stop the video here so that this video is not too long. And please pick this up in the next video and we'll work the problems. Thank you.